Stocks surging to new record highs today after the U.S. and Chinese officials eased some tensions on the weekend. Investors are also anticipating that rate cut by the Federal Reserve on Wednesday. Let's go to Ross Mayfield, investment strategist at Baird. Ross, thanks for joining us today.
Thanks for having me.
A big week, big tech reporting, and the Federal Reserve announcement coming on Wednesday. Is there any doubt that the Fed will cut?
I don't think so. Markets are pricing nearly 100% chance of a cut. The Fed doesn't like to surprise markets. And so if they were feeling any differently, I think we'd start to be hearing about it through back channels. No data, and there's been a dearth of data because of the shutdown, but no data that we've gotten would suggest that a pause is coming. I think the Fed wants to get down to that neutral rate with some haste to counter, a cooling labor market, as you just mentioned, with the news of Amazon cutting 30,000 jobs.
How many cuts are investors anticipating?
I think it's fairly well baked in that investors are expecting a 25 basis point cut this week and another one in December. Right now markets are pricing in 3 more 25 basis point cuts in 2026. But, the Fed fund futures market has a pretty mixed hit rate as far as predicting rate cuts or rate hikes, more than 6 months out. So a lot of data between now and, the second quarter of 2026 could change that calculus. But I think right now a good base case is the Fed sees themselves in restrictive territory. The job market is cooling in a way that necessitates at least getting back to neutral. If they see that as around 3% on the Fed funds rate, then they have about 4 or 5 cuts to go. The timing and the pace of 2026, I think, will just depend on the data. It'll depend on how some of these trade negotiations end up. There's a lot between now and then, but I think investors can fairly well count on a cut now and a cut in December before we start the new year.
Did the last rate cut create some momentum in housing, for example?
I think we need a little bit more, but we are certainly seeing the tiniest green shoots in the housing market. We've got the 30-year mortgage down a bit. The big issue is that the 30-year mortgage, cues more off the long end of the Treasury curve. And while the Fed has influence there, the market is also thinking about things like, percolating or sticky inflation, about, fiscal issues in the U.S. and abroad that's keeping some of those long rates sticky. So the Fed cuts are a good start, but I think the housing market needs a lot more to really put in a solid bottom and start to see a recovery in that sector, which is, functionally been in a kind of a localized recession for a couple of years here.
Do you feel like the U.S. economy is still sensitive to the lending rate as much as it used to be?
No, not even close. I think that's a really astute observation. I mean, as we were entering 2023, pretty much everyone expected a recession based on the idea that the Fed had hiked so aggressively. We had this inflation, and history had said if the Fed hikes that much, we get a recession. Well, the consumer has proven they're not as rate sensitive as they once were. The corporate sector has proven they're not as rate sensitive as they once were. Certainly, some of the more structural trends are not rate sensitive. AI, for instance, is not going to change course depending on 25 basis points here or there. So I think the lesson is that particularly compared to the 70s, 80s, even the 90s, when the U.S. had a much more cyclical economy, we're a lot less rate sensitive than we used to be. Now it still matters, pockets like manufacturing, pockets like housing, but they're just not big sections of the economy anymore. It's primarily consumer spending, and the consumer has just not been as rate sensitive as they once were. Adjustable rate mortgages are not really a thing anymore. So yeah, it's really interesting, but it's a different economy today than it was even 20, 25 years ago.
Let me ask you about the pullback in gold. Are you invested? Are you going into gold at this point?
I like gold as a diversifier. We've always liked it as a diversifier. I don't think it should be a core kind of growth or return engine in your portfolio. So the big price move doesn't really change how I think about it, nor does the consolidation here. I mean, if you're a much more tactical player, I think a big consolidation like this could have some legs to kind of reset sentiment. This was a really classic blow off top in an asset class that investors had become very, very bullish on, bordering on euphoric. It was kind of, had that vertical look to the chart that you really only see in bubbles. So I think there could be a consolidation here. I think in this environment, it makes all the sense in the world as a diversifier, as a black swan type of hedge for your portfolio. but I don't ever really want to own more than, 10-ish% of a non-productive store value type of asset. I'd rather own things that have cash flow, things that evolve with the economy, primarily stocks.
All right, Ross, I'm going to leave it there. Appreciate your time. Ross Mayfield, investment strategist at Baird.